Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend, Sam Clement. Sam, say hello.
Hey, John.
You doing okay?
Doing awesome. How are you doing?
I'm doing okay. I can't complain. And you know who else can't complain or should not be complaining over the last decade or so?
Growth investors.
Growth investors. That's right. And who should be complaining?
Value investors.
Value investors. That's right. That's right. I mean, you know, I've been doing this a long period of time, much longer than you have, Sam.
Just a few years.
And I can't remember a time when growth investing has just clobbered value investing as much as it has really over the last seemingly 5, 6, 7 years.
Yeah, I mean, you look over the past decade, and it's been pretty much one trade has been the winning trade when you look at it in these two terms, and that's growth over value.
Yeah, growth over value. I mean, you don't even have to be a genius. All you just growth over value.
Yeah,
you can be a Neanderthal. So how do you invest your money, Sam?
Growth over value. And what we
the thing is, I kind of like a little bit of both. You know, I like growth, but I don't want to spend too much for it. If you catch me, I love a good value.
Yeah.
You know.
But so what we're talking about, what we're looking at is these growth companies, these high growth companies, ones with more expensive ratios, ones that are expected to grow over the next couple of years, 5, 10 years even, at a much faster clip than what we would consider the value companies. Those are the ones where people think it's a good name, a good value. They think it's cheaper than it's supposed to be. They think there's some inherent value there, and that it's a stable, safer company. And generally, people have invested in both of those. People have had, whether it's an even split between the two, or sometimes overweight value in defensive times and growth in more aggressive times. But what we have seen is these peaks and valleys of the economy, and through it all, we've pretty much seen growth just absolutely blow value out of the water. So that brings me to the main question, and is value investing dead? Well,
I'm going to have to go back and give you a little history lesson. And this is where I'm not exactly sure as though the difference between growth relative to value or versus value, it might be as great as it was when I started off in the industry back in the early 90s. Back in the early 90s, there was a company called Barra that actually determined what was growth and what was value. It was based on the price to book ratio. And they took the S&P 500 and they rated all 500 companies by their book value, the higher the book value, and then they got to the median capitalization of the entire index. So let's say the capitalization of the index was $1 trillion. Once they got to the $500 billion in capitalization, those ones right there with the highest book value or price to book value, those would be the growth. That'd be the large cap growth index.
Yeah.
And then the ones below that, the bottom half of the capitalization in terms of price to book, that would be value. So there'd be some times where there was maybe 200 names in the growth index and 300 in the value, and then something. I think S&P bought Barra and whatnot, and then things just kind of changed a little bit. It seemed as though there was what a consultant might call style drift in terms of growth versus value, because it used to be very straightforward.
Yeah,
these companies were growth, these companies were value. Maybe you'd get a couple there almost in the middle that would be a little bit of both.
Sure.
But now, Sam, I was taking a look at some of the investment vehicles in which we invest our clients' money, that there seems to be a ton of overlap between value and growth. So how in the world can we have the same company be a value company and a growth company to roughly the same weighting?
Well, let's look at, or just think of one. One that pops in my head is Microsoft. Microsoft if you just want to think of what a growth company is, you would probably say Microsoft's a growth company.
Well, Alphabet's actually in both the value and growth.
That was going to be my next one. These are companies that when we picture them, we think growth industries, high technology, a lot of growth over the next couple of years, 5 years, 10 years, and I guess they are. But when you just look at like a price to book ratio, it's kind of a value. It's kind of a value name.
Well, the thing that's so funny about it is I took a look at these are funds that we own for our client accounts. So I do have to put that out there, but we don't make a market in it. We don't serve as principal in any transaction, serving as agent for all of our clients. So do have to say that we do own these in a pretty substantial amount, but nowhere near 5% of either of them. But the Russell 1000 Growth Exchange Traded Fund, which has a ticker symbol of IWF, we own a decent slug of that.
Yep.
And then we also own a decent recent slug of the Russell 1000 Value ETF, which goes by the ticker symbol of IWD. So ostensibly, you've got 1,000 names in the Russell 1000, right? What would you think, Sam, if I were to tell you 266? I mean, I just did the math today. 266 individual companies are present in both IWF and IWD. 266.
It's a pretty big blurred line between the two.
But I would sit there and tell you that 75% of the names in both IWF and IWV, in terms of market value, 75% of the market value are in names specific to that particular fund. So I guess another way of putting it, 75% of IWF is only in IWF, and whereas 25% of the market cap is also present in IWD.
So it's kind of like big players in both of them, and then a lot of the smaller players in these indices are where kind of the overlap is. We're seeing some, some real large mega cap names that are strictly value and strictly growth, and then when we get to some of these smaller mid cap names and smaller names, that's where we start to blur the lines between what a growth and a value company.
Exactly. And there's a couple names that aren't in either. I mean, if you take a look at some of the larger names in IWF, I think it's Apple's not present in IWD.
Amazon.
I don't believe Amazon is. I don't believe Facebook is. And when you take a look at the companies that have done absolutely fantastically in terms of truly moving the market, it's those 5 or 6 names that are in IWF, the growth side, that aren't present in IWD or the value side, and with the exception of maybe Google, which is in both, or Alphabet, I guess I should say. So is it really that value investing is dead, or we just have a period of time when a very small portion of the market has been driving the difference between growth and value? Because take a look at 90% of the stocks, and they're all moving about the same, and then you have these outliers which are really making up the huge difference.
Well, I in my opinion, I think it's kind of a little bit of both.
Okay.
So I think, take it back even 10 years, let's just look at this decade where generally growth has outperformed value for most of it. What the markets have done and what the Federal Reserve has done and the amount of money that has flowed into the markets as a whole has disproportionately impacted the growth companies, the growth indices, a lot more than it has the value companies. It has allowed these valuations to get higher and higher and higher, and those companies that are going to have those multiplying valuations are generally going to be those growth companies, those ones that people, as money inflates a little bit more, as there's more sloshing around, that people are willing to pay a little higher multiple for a company like a Apple or Amazon than they are a company that's a little more value-based.
So, Sam, it sounds like you're going back to the old Fed model in terms of trying to determine whether or not something's the stock market's at a decent valuation, and so you get to the earnings yield, right? So the lower the interest rates are on Treasury securities, the more attractive, or the higher the multiple equity investors will tolerate.
Yeah.
Because there's not as much return in the fixed income market. So right now, with the 10-year Treasury trading at 65 basis points or whatnot, it looks as though we can take a PE multiple all the way out to the moon. I mean, 25, 30% until the Fed model would suggest that there's parity there. So, if that's the case, you're absolutely right. All this dumping of money into the markets, the Federal Reserve blowing up its balance sheet, all that good stuff in order to keep the economy afloat has thereby prompted higher valuations or higher multiples, which would, of course, almost by definition, favor growth stocks over value.
Companies that the people are willing to tick up those PE ratios and willing to pay more for and let get more expensive are obviously going to outperform those where people are strictly looking for a value within those names.
So I guess the question I'm going to throw at you next is, if the Fed ever embarks on a situation where they are not driving down longer term interest rates through quantitative easing and what have you, if they ever embark upon that, would it be the time to shift more into value relative to growth?
Well, I think I'll answer that with a separate answer to part 2 of the previous question, and that is,
I'm old. I'm much older than you are. I can't think back that far.
Why I think that that we've seen this difference between growth and value over the past decade, and part of that to me is not only what the Fed's done and how it's disproportionately impacted growth names over value, but the second is the transformation that our economy's gone under over the past 10 years, really, and how much more heavy driven we are in these industries that are still predominantly growth industries. And so that's why I think, I get the value versus growth tilt, and I think there's going to be times where value probably will. I think what you mentioned is going to be a time where value might outperform a little bit, but we got to look at the economy as a whole and how our whole economy, how we make our money, has completely shifted. And I think that's something that you can't really ignore.
Well, I mean, so also you're saying the globalization
Yeah.
of the economy, of the U.S. economy.
Yeah, the tech-heavy globalization of the economy.
Yeah, because if you take something like consumer staples, like a Coca-Cola or something like that, which
Yeah.
has traditionally been, or was when I was coming along, traditionally a growth company because they were growing by leaps and bounds, but now they've almost saturated the entire world. There's
Right.
not maybe as much growth. You can't go anywhere, and people don't know what a Coca-Cola is and what have you. So all you're doing is stealing market share from local competitors and PepsiCo and elsewhere. However, with technology, now it's almost a little bit different story because the product or the service changes very rapidly as compared to a consumer staples brand, consumer staples, a brand or a product within there, that doesn't change. Kraft macaroni and cheese doesn't change terribly
Right.
much. Coca-Cola doesn't change very much. They tried to change in the 80s and no one liked it.
Didn't work.
It didn't work at all. However, how much has the technology changed even on the iPhone or
Right.
or in cell phone? I mean, just cell phone technology, just in general, or let alone, communications. I mean, a couple years ago, a Zoom call. Come on.
Right. There's new frontiers, I think, is a good way to put it, in the technology in these growth sectors that there's not really in some of these value sectors.
So what you're saying is, due to the very nature of technology and how it's constantly adapting, coupled with the accommodative, if not promiscuous, monetary policies that the world's central banks have embarked upon, it's going to be very difficult to imagine a time when growth doesn't outperform value, or at least doesn't have maybe the greater tailwinds than value.
I think that's a good way to put it. Is that the way our economy is ever changing? There's always going to be or for the most part, there's going to be more tailwinds for growth than there is for value.
So globalization is a tailwind for growth relative to value.
I think technology just inherently
Yeah.
is a tailwind because we're constantly at a forefront. We're constantly reaching new areas of. There's kind of this endless growth right now, at least where we are currently, where some of these value industries, they sell a product and they're good at the product, and there's only so much, innovation you can do in some of these traditional value sectors.
Well, you're right about that. So we got globalization is one tailwind, accommodative monetary policy, and low interest rates.
Yep.
And particularly when you have these very strange witch's brew of accommodative monetary policy and incredibly low long-term rates that can support a higher multiple on stocks. What I'm hearing you say is there's no real reason to go overweight value anytime soon.
Right. That is what I'm saying.
So are you saying, Sam, that growth is poised to at least not underperform significantly relative to value, at least for the foreseeable future?
I think if you're going to zoom out for periods more than a year,
Yeah.
you might have little pockets where we have some volatility and some more defensive value sectors outperform.
So if that premise is accurate, why would someone who is held on to, choose your large cap technology name, whatever you want, that's primarily growth, that's in the growth, it's held on to it for a decade, ever since it's really started, has a large embedded unrealized capital gain in it.
Yeah.
With what you're just saying, anything over a year, 12 months or whatnot, growth favors value, why would anyone be willing to unload these names right now just to realize a large capital gains tax consequence at the state and federal level?
Well, it's a tough argument to make, and it's one a lot of people, most investors are having to ask themselves. Most people have been overweight technology. Most funds, most most of the money in the market has been overweight to these large cap tech names that have been the ones that have been the most have been helped the most by all of these conditions that we've talked about. And I think that's a question that everyone's kind of asking themselves is, at what point do we pay 30% in taxes on this to
I'm going to tell you. I'm going to tell you one, Sam. If and when we have powers that be in Washington that want to take it to 40
yeah
or 50,
yeah
that's when you start seeing some people lighten up. Maybe not all their positions, but just locking enough in, figuring, okay, I'm going to pay 28.8% now. That's a heck of a lot better than needing the money, 3 years from now and having to pay 48.8, if you catch my drift. So that is one of those deals where I think maybe that could be one of the headwinds to growth, is if we have the potential for significantly higher capital gains tax rates at the federal level after this election,
or if they get slashed.
Or if they get splashed. So either way, any significant change to capital gains tax regimen in the United States could very easily maybe cause a little bit of shift. I don't know.
Yeah. Yep.
We'll just have to see.
We'll have to see.
Well, this election coming up in just a little while is going to have a lot of sort of hidden stories behind it, and that's just one of them. Whether or not it will impact growth relative to value, particularly since growth has dominated value for really last decade or not more.
Yeah.
So with that, Sam, what else you got on this topic?
That's all I got.
Well, that's all I've got today, too. So you all, thank you so much for listening. We'd love to hear from you also. If you have any questions or comments, please let us know. You can always send us an email to tradingperspectives@oakworthcapital.com, where you can leave us a review on the podcast outlet of your choice. If you're interested in hearing more or reading more of what we have to say or how we think, you can always check out our blog, Common Sense, at oakworthcapital.com, along with a lot of other good articles underneath the Thought Leadership tab. As always, Sam, last chance.
That's all I got.
That's all I've got today, too. Y'all take care.